Welcome to the show. I'm Samuel Sadler. I have Cary Donham of Capital Concepts here with me today.
Thanks for having me, Sam.
Thank you for being here, Cary. But we asked you on the show just so you can explain to us a little bit more about what's going on with conventional loans as far as it relates to investors.
Okay. There are really two different sets of guidelines that we're using. 1 through 4 finance properties. So that means if you own a property and you have financing on it of any kind, that's counted as a finance property.
Mm-hmm.
They do include your primary residence in that count. So 1 through 4 has one set of guidelines, and then 5 through 10 has another set of guidelines. So this is another reason that people like to do business with Capital Concepts and with me, is because we're real careful about getting them to 4 and then slowing that process down a little bit before they make a jump over to 5. I've had borrowers come in before and they go buy a hard money, not through us, but they go get hard money somewhere else, property number 4, while we're doing 2 refis for them, and that drops their LTV down. So let's talk about 1 through 4,
Okay.
and then 5 through 10.
All right.
1 through 4 is just a minimum credit score of 620 right now
Mm-hmm.
in today's market. So 620 on your middle FICO score, that doesn't necessarily mean that you'll get qualified to the 620 credit score because there are other factors, but that's their minimum. When you jump up to 5 through 10, it jumps up 100 points to 720 minimum credit score, so there's a pretty significant jump there. In 1 through 4, your cash out, your down payment on the transaction is going to be 20% if you're doing a purchase, and they'll give you a 75% LTV, loan to value,
Mm-hmm.
on the back end for a refinance transaction. That's 1 through 4. 5 through 10 is 25% down, and they'll do 70% on a refi. So as you can see, there's a 5% difference in LTV
Mm-hmm.
moving from one section to the other. Reserves. Reserves just mean what you're going to have left in your bank account after you get through with the transaction. If there's a down payment, if there's closing costs involved that you're coming out of pocket, what's left over. They require on 1 through 4, 6 months on the subject property. Now that's 6 months PITI and any homeowners association dues. So it's basically your debt service. And 2 months on any other second home or investment properties. When you move to 5 through 10 finance properties, what happens is that goes up to 6 months PITI on all loans.
Mm-hmm.
Now I want to talk about cash outs. I'm going to talk about the normal guideline on cash outs, and then right now they have something called delayed financing, and we'll talk about that. But 1 through 4, they allow cash outs. But to do a cash out on a property and actually pull cash back on that transaction means that you have to sit on that loan, or I should say you should have title seasoning for 6 months. That means that by the time you buy the date you buy the property, if that's January 1st, then you're going to have to wait until July 1st to be able to do a cash out transaction. So what it boils down to is we can take an application 181 days after your purchase.
Okay.
If you're doing a cash out. 5 through 10. 5 through 10, they don't allow cash outs on 5 through 10, except with the delayed financing. So the way the delayed financing works is Fannie Mae came in and they started assessing how many REOs they have in today's market. And as of this recording, millions. So they realized that they were shooting themselves in the foot for investors that wanted to come in and quickly buy a house cash. They weren't allowing them to finance that property afterwards. So they came in and said, well, we're going to add a little overlay on top of our own, or an exception to the rule on top of our own guidelines that says, we'll allow you to do what we call delayed financing. So you can go purchase that property on January 1st, and the 2nd of January, you could come back and you could do a cash out, but they're going to limit you to the cash that you can get on it. Only your purchase price plus your closing cost on the transaction, no repairs.
Okay.
So it might not make sense to do that unless it's a property that maybe only needs $3,000 or $4,000 paint and carpet.
That makes perfect sense.
That's really the difference between 1 through 4 and 5 through 10.
Okay. I could see how that would be a surprise if you didn't see that coming.
Absolutely.
All right. All right. Thank you very much for coming on the show. Cary
Thanks,
Donham,
Sam.
Capital Concepts. I'm Samuel Sadler.